While the world was celebrating the so-called China-US trade truce in November, when Beijing appeared to ease export controls on rare earths, gallium, and germanium, something far more dangerous happened quietly behind the headlines. China kept one metal completely locked down: silver. And they chose January 1st, 2026 as the execution date. That's 21 days from now. And once you understand why that date matters, you'll realize this isn't just another trade policy tweak. It's a calculated chokehold, one designed to corner the US silver market the moment the calendar flips to the new year. Let me show you why. Think back to what happened in Busan last month. Trump met with Xi Jinping. Headlines exploded with optimism. China, we were told, was backing down. Reuters reported that Beijing had suspended export controls on rare earth elements, gallium, germanium, even antimony. Markets cheered. Analysts declared the trade war was cooling. Wall Street exhaled. But here's what almost everyone missed. China gave up minerals they could afford to loosen. While tightening their grip on the one metal the energy transition cannot function without: silver. Today, silver trades around $62 per ounce, up more than 115% since January 2025. The old all-time high of $61.94, completely erased. But this isn't a speculative bubble. This isn't retail hype. This is positioning. Ahead of a supply shock most investors don't even realize is coming. Let me take you back to October 2024. That month, China exported 660 tons of silver, the largest monthly export on record. Where did it go? London Metal Exchange vaults, COMEX warehouses in New York, Swiss refineries processing metal for Western buyers. On the surface, it looked like strong demand. In reality, it was something else entirely. It was front-running the shutdown. Chinese exporters knew the window was closing. They shipped every ounce they could before January 1st, before the rules changed. Think of it like the final flights leaving an airport right before the government seals the border. That October surge wasn't normal trade. It was an evacuation. And here's the mechanism most analysts completely misunderstand, because they obsess over price charts instead of policy documents. China didn't ban silver exports outright. They did something far more effective. They nationalized control through licensing. Starting January 1st, only companies producing 80-plus tons annually, or 40-plus tons in select Western regions, can even apply for export licenses. How many companies qualify? Fewer than 20 across the entire country. Every single one state-connected. No independent traders, no private exporters, no open spot market. If you're a U.S. solar manufacturer needing 1,000 ounces next quarter, you don't negotiate with the market anymore. You negotiate with Beijing. You deal with exporters that answer to MOFCOM, China's Ministry of Commerce, not to you. Now ask yourself, why January 1st? 3 reasons. And together, they prove this move was strategic, not administrative. First, the timing came after the November trade talks. China gave headline concessions on rare earths while quietly keeping silver locked down. It was misdirection. Give them what they expect, so they don't notice what you're keeping. Second, January 1st is when U.S. manufacturers finalize Q1 supply contracts. Solar, electronics, medical devices, they all lock orders in December. But this year, there is no certainty. The approved exporter list won't even be published until late December, leaving U.S. buyers scrambling with zero notice. Third, the timing aligns perfectly with collapsing Chinese inventories. Shanghai Futures Exchange silver stocks now sit at just 780 tons, the lowest level in over a decade. In 2019, over 2,400 tons. China is securing domestic supply first, feeding its own solar and electronics industries before anyone else. And here's the confirmation that this wasn't accidental. On November 7th, 2025, just days after China announced the silver restrictions, the U.S. Geological Survey added silver to its official critical minerals list for the first time. Read that again. Silver is now officially classified as essential to national security, with supply chains vulnerable to disruption. Translation? The US government saw this coming, and China knew they would. That's why silver, not rare earths, remained under control. Now let's talk numbers, because this is already happening in real time. Shanghai currently holds 780 tons of silver. China's industrial demand, 5,200 tons per year. Solar panels alone consume 3,500 tons annually. Add electronics, EVs, medical equipment, water purification, and you see the problem. China mines roughly 3,600 tons domestically. That's a 1,600-ton deficit every single year. They've filled that gap with imports and recycling. But once exports tighten on January 1st, that math becomes our problem. MOFCOM announcement number 68, issued October 30th, lays it all out. Production thresholds, massive credit requirements, ISO certifications, historical export proof. These aren't quality controls. They're filters, designed to eliminate competition and consolidate power. This isn't a quota. It's not a tariff. It's a monopoly. One Beijing can tighten at will, and the physical market is already screaming. Silver lease rates in London spiked above 15% earlier this year. Normally, they sit near zero. By September, they hit 30x normal levels. Banks couldn't source metal. Refineries rationed supply. Freely circulating silver inventory is now estimated below 4,000 tons globally. In normal conditions, that number is closer to 15,000 tons. Why? Because smart money isn't waiting for January 1st. Industrial buyers are stockpiling. ETFs have removed over 200 million ounces from circulation. Physical silver is being vaulted, not lent, not sold. And if you think this sounds familiar, it should. In 2010, China restricted rare earth exports. They didn't ban them, just licensed and limited. Prices exploded. Neodymium rose 500%. Dysprosium surged 2,000%. Silver is worse. There's no quick mine restart, no strategic stockpile, no circular recycling loop. When silver is used in solar panels or medical devices, it's gone. Global demand in 2025, 1.2 billion ounces. Global supply, 1.16 billion ounces. We're already short. China exports roughly 135 million ounces per year. If exports fall just 30%, that removes 40 million ounces, on top of the existing deficit. That's an 80 million ounce hole with no immediate fix. So where does price go? Demand destruction, recycling, mining expansion. None of those happen quickly. At $70–$75 per ounce, the market begins to rebalance. And that's why $65 forecasts are wrong. The gold-silver ratio sits near 68. In past supply crises, it compresses sharply. Even a move to 60 puts silver above $70. And fundamentals today are far stronger than 2011. January 1st isn't symbolic. It's operational. It's the day the open market disappears, and allocation replaces it. The math guarantees higher prices. The only question is whether you're positioned before the market fully understands what just happened. If this analysis helped, hit like and subscribe. Drop your silver target for Q1 2026 in the comments, because this is the kind of story the mainstream financial media won't connect until it's too late.